Federal Reserve, of course, is set to meet this week. Investors are going to be looking out for signs that the fight against inflation is over and that interest rates will be cut sometime this year. Rick Reider is joining us, BlackRock Chief Investment Officer of Global Fixed Income. Rick, it's great to see you. I want to start here, Rick. Has the Fed succeeded? I mean, you look at the GDP print we just got, you look at the PCE reading we just got, you look at consumer confidence, it's looking pretty good. What do you think?
So I know it's a question of the Fed succeeded or the economy succeeded. It is, that listen, I think we're seeing an economy that is much more vibrant, much more resilient than people give credit to. I mean, for a year and a half, people have been saying the recession's coming. I heard somebody say hard landings start with soft landings. I don't even understand. I mean, you look at there was a lot of wisdom. The claims data, the retail sales data, the GDP data, the payroll data. Economy's in good shape. It's a service-oriented economy. Service-oriented economies, we've talked on your show the last few times. They don't really go into recessions, and you're seeing some real vibrancy. And the payroll report, like you were saying at the outset. Listen, you can never pick one payroll report in terms of what it does. I'm going to be focused on some things like leisure and hospitality because that's a big cyclical and what happens with regard to that temporary hiring. So are you starting to see an economy that's maybe slow, the cyclical component slowing a bit? That's going to be worth watching. But gosh, it's hard to complain about a tech-oriented U.S. economy, a service-oriented economy that can take a lot of shots. I think people underestimate how I used to call it the most resilient economy in the world. I still think that's right.
And Rick, I don't know if you're about, I was talking to Julie there about kind of Jay Powell's mission at this press conference this week, Rick. And, on the one hand, he's got to be happy, right, with the data he's seeing in terms of the trajectory of inflation, the resilience of the economy. And at the same time, Rick, though, he doesn't want to, wave the victory sign and spark this financial markets rally like we saw last month. How do you think he kind of just walks that tightrope?
I think you hit exactly the right point. Listen, the markets, you think about what happened at the end of the year. Markets were incredibly overzealous about Fed can start cutting now. And, the markets had jumped on a couple of things. One, there was a lot of money, particularly long end of the curve, that was coming in year end. And then inflation has been coming down significantly, and the markets jumped on top of that. Listen, I think that that he wants to walk a very tight rope, exactly like you said, create balance. And, will he take the tightening bias off? I think he will. But listen, I think March is aggressive. I didn't know who said it at the beginning of your show. March is aggressive because you have time. In an economy that's operating this well, there's not really a race to move rates down of any significance. And by the way, when you start going, and I think they're going to start going in May, and I think they'll do 25 basis point cuts every other meeting. But by the way, let's say the data does turn down, you can do 50s. You were hiking at 75s. So I think they've got a bit of time, and I think he's going to want to walk that back a bit, some of the overzealousness that you've seen certainly in November and December, and then so that you don't get financial conditions getting way ahead of the Fed. But I think that is going to be a key.
Well, look, Rick, things are still kind of zealous, aren't they? I mean, that's what's so interesting, right? Is that the perception was in December, the Fed's going to start in March, stocks rally. Well, perceptions have come back, right? We've seen the odds of a March cut come way down. Stocks are still up. So what would derail the rally that we have been seeing here?
I think I don't think that when you talk to people, there are very few people that I talk to that say, gosh, I really like stocks, I'm jumping in. I think there is an immense amount of cash sitting on the sidelines. And what happens is, so you think about the technicals drive markets more than fundamentals, certainly in the near term. Think about what's happening. There is going to be almost $1 trillion of equity buybacks this year. There's no IPO calendar. All buybacks, no sellers. There's a huge amount of money sitting in cash. If all people do is take some of their salary, 401k money, and just I'll put a little bit of money in equities, there's not a lot of sellers. And so what happens is the market just continues to take some of the cash and move it in, and you don't have anything that gets in the way of it. So I don't really think there's a collective, let's buy stocks. I think it's, gosh, I got money coming in, I've got to asset allocate. The big thing I think this year that's different than last year is now a good deal of that money's coming into fixed income and income producing assets that are saying, gosh, I've been sitting in cash, I'm getting 5 and change it in a money market. Now maybe I'll move into income producing assets. Maybe I don't get those huge returns in equities and I can augment it with income. And that's a big divergence from what we saw last year, where people were like, get me out of the way of higher interest rates, I'll sit in cash.
And I'm interested, Rick, when you look at the credit sectors right now, which ones kind of make sense to you, Rick? Is it investment grade and high yield? And also, where don't you see value?
So first of all, the rates I don't see spreads. So if you take normal spreads, you think about it versus history, they're not that interesting. And in fact, high yield, they're not that interesting at all. What I do think is really interesting, though, is owning assets in yield. So if you think about why are companies borrowing at these levels, they're only borrowing at, why is high yield borrowing at 8-ish? Why is investment grade? Can you buy investment grade at high 5s to 6? It's because the risk-free rate is so high. These companies term their debt out. They're in better credit quality than they've ever been. Where what I really like is just own these assets in yield. And don't focus as much on spread, because we're going to get tons of issuance out of the Treasury. But a lot of these companies today are pretty darn attractive. Where I really like is Europe, because a dollar investor, you can swap back to dollars. And listen, an environment where we can get these sort of yields, EM is just okay. Do I want to own a lot of EM? If I could build a portfolio of 6.5% yield, we just launched this ETF, or didn't just, about a year ago, that, we can get 6.5 using things like agency mortgages, investment grade credit, high quality assets, and build really nice yield into a portfolio. So it's spreads that aren't that interesting. Places like we have a lot of volatility, not that interesting. And, just build yield and sit on it. Let the yield work for you this year.
Where do you think the 10-year yield is going to end 2024, Rick?
So, what the 10-year to me is like? It's like a lost soul that found its home. And so if you take where we've been bobbing, where it's this incredible move. You think about it, when you hit 5%, people say we're going, the 10 years going to 6. The 10-year moves, and historically has been where nominal GDP is. Nominal GDP, if you say real GDP this year is 1.5 to 2, inflation is 2.5. Let's say we end about 2.5-ish. The 10 years of 4%, or the nominal GDP is 4%. 10 years at 4%, a little behind 4. I think the 10, I think the key for rates is volatility is coming down, which is good for equities. Where does it end the year? My sense is with a Fed that's cutting rates, I think you'll get the 10-year 3.5 to 4. But I think the big story this year is finally, after 3 years of not being able to sleep at night because rate volatility was all over the place, mortgages, so it's hard to buy agency mortgages because rate volatility was so high. I think the story this year is the 10-year found its place. And now we can own a lot of income and just hold the income.
Well, that's good news for you, I guess, in your sleep too, Rick. Thanks so much for being here. It's always good catching up with you. Really appreciate your perspective.